Welcome back to Brisbane Property Uncovered. Everyone's talking about the cost of debt right now. Rates are high, repayments are up, and most people are feeling the squeeze. But here's the thing hardly anyone's saying. The debt you take on today might actually be a fraction of what it's worth in the future. And that's because of one simple force that's been shaping wealth for decades: inflation. Let's start with what's happening right now. The US just hit $38 trillion in debt, and they added another trillion in just a couple of months. That's not just a number, it's a sign of where we're headed globally. To manage that debt, governments have two options: raise taxes or print more money. And as history shows, they usually choose the second one. When more money floods the system, the value of each dollar drops. That means everything costs more. Groceries, petrol, housing, even your morning coffee. But here's the flip side. It also means that the debt you're carrying on your mortgage is being paid back with dollars that are worth less and less over time. Think about it this way. If you borrowed $800,000 today and inflation keeps ticking along, in 10 years that $800,000 will feel like much less in real terms. Your wage will likely rise, prices will rise, and yet your loan balance stays the same in nominal dollars. That's why, historically, property investors have always used debt as a tool, not something to fear, but something to leverage, because while money loses value, real assets like property hold or even increase in value. You can't print more land, you can't digitize shelter, and Australia's demand for housing with record immigration and limited supply isn't slowing down anytime soon. So in an inflationary environment, the people hold real assets with fixed debt often come out on top. They're paying back yesterday's dollars with tomorrow's inflated income. Now, this doesn't mean you rush out and buy anything with a roof. It's about being strategic, structured, and understanding your numbers. And here's where I want to clear something up, because a lot of people mix this up. If you're planning to invest or grow wealth through property, you should absolutely seek financial advice about what's right for your circumstances. A financial advisor can help you map your long-term goals, manage risk, and plan your retirement strategy. But, and this is a big one, your financial advisor can't provide borrowing capacity. That's where a mortgage broker comes in. Before you can act on any strategy, you need to know exactly what you can borrow, what structure suits your goals, and how to set it up right from the start. That's my space, helping you make those decisions confidently with the numbers in front of you. So here's the big takeaway. While most people are sitting back waiting for interest rates to drop or the market to crash, smart investors are positioning themselves now, securing debt against assets that grow in value while the dollar weakens. Because the truth is, debt today could be one of the smartest tools for wealth creation tomorrow, if it's backed by the right asset and structured correctly. So yes, always get advice, understand your risks, and plan for your future. But before you do any of that, come speak to your mortgage broker, because that's where the plan actually starts. If this hits home, follow along for more insights on how to use property, finance, and strategy to get ahead. And remember, in a world where money loses value, real assets win. Thanks for listening to Brisbane Property Uncovered. If you want to talk strategy or explore how to finance your next purchase, reach out to me at MoneyQuest Manly. I'd love to help you get started. Have a great day. Thanks.